This is the Passive 25K podcast, a podcast built around the vision of creating wealth through passive income for ourselves and others. The idea of creating income while you sleep seems like a dream come true, but for most professionals, turning this into a reality is a different story. On this show, you will hear real people breaking passive income streams down to the basics, giving you the next steps to start your own passive income journey. If you're new to the show, my name is Kyle Reedstrom from Fargo, North Dakota, where I get to work with my team of agents and investors each day to complete our goal of $25,000 a month in passive income. Now, let's get right into our next conversation. Welcome to the Passive 25K podcast with Kyle Reedstrom. I'm your host, Kyle Reedstrom, of course, and today's topic is raising cash to buy a sevenplex with creative partnerships, and our guest is Andrew Myers, who has done this. Andrew, thanks for being here, man.
Thanks, Kyle. Thanks for having me. It's a privilege buddy. And an honor. Thank you.
Love having you on here. I'm going to give a little bio for our audience so they know who we're talking to, give a little credentials here. Andrew is the owner and operator of LGS Properties and has 13 plus years experience in commercial real estate and in the public and private sectors, as well as 5 years in real estate investing experience with 5 properties under management across the states of Colorado, North Dakota, and South Dakota, which includes a 5-unit and a 7-unit here in Fargo. He has short-term rentals, Airbnb, VRBO, as well, and he runs his investing business while holding a full-time W-2 job in project management. Also enjoying life with his wife and 3 little boys. I'm glad you put that in there, Andrew. He holds a master's in real estate and construction management from the University of Denver. Andrew and his family currently live in west suburb of Denver. Man, you got some stuff on your plate, Andrew. I love it.
Yeah, a little bit.
Very good, very good. Well, I love that bio. I love the relationship that you and I have formed in the last 2 years. I've really enjoyed seeing not only your passion and like your expertise and interest in real estate investing, but your interest in your lifestyle and your family and the way you pour into your 3 boys that I've been able to hear from our conversation and see on social media as you travel. Man, that's one of the things I admire most about you, just so you know. I know this is about business, but hey, all this business goes towards family, right? So
I appreciate it. Yep. Yeah. And I love your quote of I'm a family man with a business, not a businessman with a family. So
that's right.
I always keep that in mind.
That's really good. That's the front row dad's plug right there. But I want to start by asking you, we got all that, the lay of the land there, and we got some of what you've been doing, but tell us why. Maybe we were alluding into some of that, but tell us why you're going down this path.
Yeah, absolutely. Things change when you have little kids, right? So once we had kids, my oldest is 7 years old. I have a 4-year-old and I have a 22-month-old. So when when we were talking about what our future looks like with my wife and I, we wanted to plant the seeds for the future for our boys. That was one piece. That was our why. And we're so glad that we have planted the seeds with our 5 properties that we manage now. But, the other part of it is the whole idea of passive income, financial freedom, the choice to do with your day what you want, not being forced to or being bound to a boss or a job or anything like that. So this eventually, hopefully, will turn into something that is full-time. And so that's probably the second why that I'd share.
That is so important, man. That's what we're here. That's what we're about on the Passive 25K podcast.
Yep.
Money's good for the good it can do, right? And money might not be able to buy you freedom, but it can buy you options in order for you to choose your path.
Absolutely.
As part of that, man, did you and your wife kick this around for a while? Was this like dreaming and scheming and no action quite right away? Or did you guys just jump right in, or how did that work?
Well, it kind of started, not to give my origin story with real estate investing, but it kind of started with us reading a couple books. It was Rich Dad Poor Dad, which I'm sure has come up or will come up on your show.
Yeah, buddy.
And I read that way too late. I'm 30. I'm 39. I read that when I was like 32. I wish I read it when I was 22. Right.
All right. Take notes. Anybody that just heard that in the audience, you take notes that you can. If you're listening and you're in your 20s, you got to read that right now.
You got to read that.
But the other careful, one could change your life.
It will. It'll change the trajectory of your life. And the second book was a Bigger Pockets author, Scott Trench, Set for Life. That was another inspirational book at the time. And really it was, we were renting a house from my parents, and I was commuting 45 minutes or more per way. And we were like, we need home ownership. We need to get into it. How are we going to do this? And so reading those two books, listening to a lot of podcasts, we decided we think that we can afford a house if we house hack. And I don't know if you've covered that topic yet, but basically living in a portion of a house and renting the other part of the house out. So that was our first real estate investing venture, was purchasing a home in 2017. It was a 1,800 square foot bi-level house, and we lived on the upstairs, and we sealed off the downstairs that had an existing mother-in-law unit, and we Airbnb'd that sucker for 2 years and paid our entire mortgage for 2 years. In Colorado. So we built equity over the 2 years. We got experience in Airbnb investing, not with a lot of funny stories along the way, most of them including cannabis incidents and things like that in our home with our 2 kids. But you know, it was all worth it to get to where we are now. So.
Okay, dude, that's a perfect plug for our first episode ever about house hacking. But awesome. That's your entrance into this. I'll call it kind of a paradigm shift of thought. In hey, we are having our mortgage paid. Oh wait, so our debt's going down thanks to the income that's coming in, and our values obviously going up. You still own that property, Andrew?
We do, absolutely.
Nice.
It's now a long-term rental. And we clear about $500 a month in cash flow on that net.
That's awesome, man. So this obviously started a lot of conversation, and then enter in the bigger thoughts. You know, talk to us about how that kind of progressed. And I hear a lot of like you and your wife too. So I love the aspect of, you know, this wasn't just a journey for you.
Yeah, no, it absolutely is. I consider her my silent business partner, right? She's not on the front lines doing the deals and stuff, but she's certainly my sounding board and my reality check, and she's a lot. So she's the backbone of a lot of this. So we were getting our feet wet with real estate investing that way. But I was doing a lot of studying around real estate investment, books, podcasts, talking to friends, talking to people that I knew. And all of a sudden I got to a point after about 2 years of hardcore education. I was just like, I got to do something. And my barrier for a long time was I don't have the money or the capital to do it. So I just kept telling myself, I don't know how I'm going to do this, but I got to take some action. Like I'm ready. I got to be confident in that. So fast forward to 2019, fall of 2019, I said, I'm just going to go for it. So I had read a couple books. One was called Raising Private Capital. I'll plug that. It's by Matt Faircloth, Bigger Pockets publisher, author and publisher and contributor. And then also David Greene's Long Distance Real Estate Investing. Both of those books were pretty much my guidebooks to taking the next steps and taking the first steps. And so what I did on my first go was I invested in a tiny little town of Aberdeen, South Dakota. I borrowed $25,000 from my mother-in-law and $20,000 from a buddy of mine, for a total of $45,000. I bought a tiny little single family home there for cash in the Burr method. If you've ever covered that, your listeners can look that up. BRR, which is buy, rehab, rent, refinance, and repeat the process.
Yes, a lot of R's.
So we bought that. I bought that with cash using private capital. I structured that deal with I made it all legit with my mother-in-law and my friend. We had promissory notes written up. In retrospect, I probably should have and could have secured that loan using the property as collateral. Most attorneys would probably say that's smart. So I did not do that, but I would probably do that in retrospect. So I purchased that property, got it rented. I actually didn't have to do any rehab, so I eliminated one of the R's. Mm-hmm. And I rented it out for $875. So if you do the math, $875 on a $45,000 property is about 2% on that. So I was able to refinance out of that with a commercial loan there, and got all of my money and then a few $1,000s on top of that out of the deal. And I've had that property ever since, and it's rocking.
Still have the asset. Man, you just put a whole bunch of gold in one place. And so real quick, I want to just backtrack. When you mentioned, I had a question pop up when you did those agreements with your partners in that, or the capital that you partnered with. Now let's remember, this was not Andrew's money, which we're going to get into deep into this episode, which I'm excited about. So you had 25 and 20, and you did some, promise. What were the contracts? What the legal look like on that? Did you do that off of documents you had, or did you use a lawyer?
I used an attorney. Yeah. Okay. I have a real estate attorney here in Denver. And I had to advise my partners, my mother-in-law and friend, that listen, my attorney is representing me. If you would like to bring your own counsel to review the paperwork, you are free to do that. I mean, that should be customary advice to people you're doing a deal with, is that they can bring their representation just as much as you can. So I had an attorney draw up the documents, same documents for each one. And here's how I structured that. I basically promised them 10% on their money with annually. So let's say, annually, so 10% on, let's say 25,000, I promised them 2,500, but I promised them at least 6 months of interest. So even if I refinanced in year 4, or excuse me, in month 4, and I repaid them back and forth, they would still get a full 6 months of interest. Because I always have the thought that you have to make it worth their time and effort to just thinking about this and making it pay off. So I think I paid them each about, $1,000, $1,200 or something, depending on the math, for using their capital.
Dude, and then you were able to pull all of your initial investment out, pay them back, plus the return, still have the asset. How much is that cash flowing for you right now?
Cash flows about $300 a month. And latest appraisal estimates anywhere from 80 to 95,000 current. So I've been able to grow that equity. And one thing I always like to talk about is, with this property, I found a distressed seller, not a distressed house. I think that's a distinction because in real estate investing, we always talk about a distressed house, right? One that has been abandoned or whatever. I had a seller who was just tired of having this house because they inherited it in a trust transaction, and they let basically about a $65,000 house. They let it go for 45,000. And so the house was great, didn't need any repairs, but they just wanted to unload it. And so that was the important thing about finding a deal, right? You got to find that deal, whether it's a distressed seller or a distressed property.
That is an awesome tidbit there, Andrew. That is usually, if you're getting a property under value, it's just like you said. It's usually the property's distressed or the seller is distressed, as you put it, and needs an out, and you're able to solve that problem for them.
Yep.
Really appreciate you going into how you kind of structured that with an attorney. It's a simple document, promissory note with the simple terms that you put in there. You did everything by the book. This topic matter of raising money can be really scary and overwhelming. But if you just keep it clean, authentic, and truthful, and open book, this doesn't have to be icky. I think that's part of this world of private capital. I mean, and I just hear that in what you're saying, Andrew.
And keep it simple. Keep the terms simple that they understand. There's nothing complicated about, I'll give you 6 months interest guaranteed, 10% on your money. I mean, it doesn't get much simpler than that, right?
Yes.
And especially on this first deal, they were investing not in the property, they were investing in me. They were lending, they were trusting me with their money. So I had an unofficial fiduciary responsibility, I think, to make sure that that their money was in a good place, and it worked out. So they took a chance on me, which I appreciate, which a lot of people have, and I was able to fulfill my duties as a partner. So
that's excellent. And you talked about the barrier, man, that was keeping you guys stagnant. And you said, I just had to do something. And I talk a lot about the pendulum of analysis versus action. And it's got to swing. And I see some people's pendulums like a magnet on the left side that gets stuck on analysis and they never do anything. And you got to have a healthy relationship with both. And I champion you for jumping into that in a world where your barrier, as you said, was money. How many people, it's either time or money that I always hear why people aren't getting into creating passive income or getting into real estate investing. It's time or money. And sometimes time is a legitimate argument. But the money one there's so many ways to overcome that. You're a walking example of that, man. And I want to dive into that topic. That's the barrier that we're focusing on today. That's the pain people are feeling. So when it comes to raising cash with creative partnerships, like I said, it's a hot topic. And I want you to explain your structure overall for this, okay? So generally speaking, people that are unfamiliar with this, you're just touching on it with a mother-in-law and a friend. But if you were going to do this again and again, which you have, but what is the general structure? What are the parameters that people need to kind of think about when they're in this world?
First thing I'd say is actually the first action step I would challenge your listeners to take is make a list. This is like a CRM, like a client relationship management list. Make a list of everybody you know. Everybody you know. People you work with, family members, acquaintances, schoolmates from the past, everybody you know. I actually thought I knew more people, but my list was about 250 people. And you start looking at that list, and you can even narrow down that list to people who you think might be a good partner, might have available resources, might be interested in real estate investing as an asset class. You can start whittling that down and segmenting that list into potential partners. And that's exactly what I did. And I don't take credit for that. That's an action item in that book, Raising Private Capital. So that's not a novel idea. But that's exactly what I did. And to your question, Kyle, the most important thing I think to figure out is, what are the goals of your potential partner? What are the financial goals of your potential partner? You have to make sure. So I'd say that, what are the goals and what is their tolerance for risk? Because there are advantages and disadvantages to certain type of partnerships in real estate investing. Number one, my friend and mother-in-law were lending partners. So if I were to collateralize those loans, they would have been protected by the property itself. Now, I didn't do that. I would do that in retrospect, like I said. But they can fall back on that. If I default, then they actually receive an asset, right? They can foreclose upon with a loan and all that. The other part is entering in partnerships, where that's a bigger legal risk, because you're marrying up with that person, that operator, that investor, me in this case. They're partnering up with me for the long term. So their money is not liquid. That's the other advantage of lending. Their money is not liquid. It's tied up. It's dependent on the performance of the property. The risk is spread out among however many partners are in the group. There are different levels of risk. So I think assessing, one, the financial goals of a potential partner, and two, understanding what their level of risk is, can help you understand where they might fit into your real estate journey if you are trying to raise capital for a real estate investment.
I love that, man. So you're making a list. You're fostering conversation with what their goals are. How did you go about some of that, Andrew? You know, when you're starting to walk down that path of conversation.
I started with an initial list, like a very small list, where I just started talking to people. I would take people out to dinner, take them out to coffee. Here are my ideas. Here is something that I want to do. And here's where you could come in and help me and partner with me. And here's how you could benefit. Here's also how you could lose, being very upfront with the risks. And here's what we can do together. But in talking about the risks, you're talking about liquidity of that money. Like, you know, how do you think they're going to need their money for some big expense? They may not want to lock it up in a partnership. You know, I'm having those conversations with this small group, and then kind of over time, just increasing that bubble of people that I'm talking to. Whereas you get started, you know, people start getting interested. Plus, at this point, you start having a track record. So, you know, you're a little bit more legitimate. Once I overcome the imposter syndrome that I always have, that many people have. But I think it's just working from a small group to a larger group to a larger group, and actually talking to anybody you know about real estate investing. And then people get interested, and you get in conversations, and you start forming partnerships and start, you know, maybe JV possibilities and whatever. It kind of just grows from there. And the thing I learned is, once you start talking about it and pursuing these things, the freight train of momentum is a real thing. So that's always a caution I have for people, is once you start these wheels turning, sometimes they don't stop. So just be ready for that.
Yeah, be ready for success, right? People kind of wait around and like think about failure, but be ready for success as well. Man, that is a theme that's came up before with being open, sharing your vision, sharing your goals. That's how you and I first connected. I remember hearing a lot about what you wanted to do, who you were looking to build your team with as far as experts in different areas. Man, you've always been so open about that from the start. And that's just, I think, helped people gravitate towards you, create trust because of the clarity of your vision. And I think that's a great tidbit for people to, you got to know where you want to get to and paint the picture of the final product of why, where we're going, why. And sometimes people want to jump on that train. And if they do, here's some options. If they don't, on to the next type of thing, man. So that's.
And Kyle, maybe it's not right now. I've had a lot of people that said, hey, I'm interested. I just can't do it right now. Or I just don't want to take that risk right now, but later call me. So
I love it.
You got to keep those in, it's typical sales. You got to keep a little flag on that person. And then when you pursue another deal, call them up and see if they're ready at this point.
That's awesome. That is okay, Andrew, we're going to take a little break, and then I want to dive deep into a specific example on the 7-plex that you structured. And we're going to walk through how that whole thing went, because I think that's been such an awesome win for you guys and your partners. So we'll take a little break, and we'll come back and dive into those details.
All right. Thanks, Kyle.
Hey, wanted to take a quick break from this week's episode. Wondering if you ever ask yourself, how do I get started in this stuff? Or if I'm already doing it, what are some next steps or people that are doing the same thing that I want to do, people on this passive income journey? Well, we were getting that question and we created a community of passive income investors called Passive Income University. This is a place where you can watch videos, things that we've done, where we put tools and information, where we've built a community of people that can communicate, ask questions, and grow together to start their passive income journey. And eventually we complete our passive income journey together. If you're interested in more info on Passive Income University, check us out at p25kg.com. All right, Andrew, I want to get into the heat of this whole podcast, why we're here, which is the specific example of the 7-plex that you acquired using this creative partnership style model that we've already talked about. So I'm going to give the floor to you. I want you to walk through this. This is a 7-plex on 10th Street North in Fargo, by the way.
Yep.
And it's been an amazing deal for you and your team. Here's the mic for you, man. Tell us about this deal and really dig into not only what the deal was, but how you structured this for you to benefit as the person organizing it and your partners.
Okay. All right. Yeah. So like I said before, I was talking with a lot of people that I knew about possibly getting into a deal together. And what we are not going to talk about is I bought a 5-plex there in Fargo and put that deal together. The 7-plex, I think, is a more interesting deal, which only came 3 or 4 months after we purchased that 5-plex. Mm-hmm. So I had been talking to a lot of people about joining one of my deals, and a couple friends that I knew, one of them I had worked in my previous job. He was a consultant that I worked with, and we just clicked. Our personalities just meshed. He was interested in real estate investing. He had the money, just not the time. And then another buddy of mine was a CrossFit friend from back in the day when I was at a CrossFit gym. And same thing, he was very interested in real estate investing, and he was a high wage earner and just didn't have the time to run deals. So he said, absolutely. So even before we identified this property, I did a lot of the legwork to put the deal together. And again, we utilized an attorney to put it together, an operating agreement that worked for all three of us. And because we were going to register this entity and purchase a property in North Dakota, potentially Minnesota, but I think we were just focused on Fargo at that point, we utilized a local attorney. I think one of your recommendations, Kyle, to work through the operating agreement. And the operating agreement is basically the document that your group is going to rely on. And I hate to say it, if something goes south, if something turns bad, you're going to pull that off the shelf and say, what did we agree to as a group? It's not meant for when things go well, because everybody's happy, right? It's meant to protect all parties in the event that something goes wrong. So we put that together with all the terms, and it talks about everything from how we're going to distribute money, how we're going to vote on major decisions, who has the votes, how much weight do the votes hold for each person, how is the partnership split in terms of interest and shares in the operating agreement and in the partnership. It's a pretty extensive doc. I'd say it's about 30 pages. But
Yeah,
it
and this is
to cover.
And I want to jump in real quick on that, Andrew. With some of those details that you talk about, what were some of the ways that you actually kind of put those together, just really generally, even like when it comes to voting, when it comes to equity, how did that all work in your operating agreement?
Yeah. So again, like we said earlier in this conversation, we did what we could to keep it simple. We didn't want to overcomplicate things. And you can certainly overcomplicate an operating agreement. But we started with a template that the attorney provided to us, and then we kind of went through each section. And it's really just a meeting of the minds and what everyone's comfortable with. And so, with like voting, everybody has a vote, right? An equal vote. It doesn't matter about your shares. You could structure it like that. If someone has 40% of the partnership, they could have 40% of the vote. But we kept it fair. And so all three partners have equal vote to any of the major decisions. We did make me the managing member of that. And the operating agreement outlines my responsibilities in handling money, in managing the asset, providing the bookkeeping and accounting services for the group, all of those things that go into the day-to-day. And then it also says, hey, here are the times when the group needs to vote. Disposition, selling the property, refinancing the property, dispersing funds, all those things require a vote of the parties. So it's a lot of things. It's a lot of things like that. And then it goes into some of the things like the things you don't want to think about. What if one of the members becomes incapacitated or passes away? What happens to the partnership interest after that? That's important stuff because real life happens, and the worst case scenario, you hope doesn't happen, but it could. And so those are the things that you have to just focus on in there. So as you can see, a lending scenario can be much easier than a partnership scenario.
Here's my money, and then I'll go do what I'm going to do and give you your money back plus interest. Yeah, you're right. There's different complications.
There is.
I like that. I like this option. I want to continue to kind of make our lists of different types of creative partnerships that exist. We talked about lending. Now we're kind of in that equity category. Yes. There's definitely like a combo of that can kind of be both and. So you're in this operating agreement for this 7plex. You got a couple guys interested. There's you, of course. There's 3 partners.
Yep.
You're the managing member, which, I always think of, you're the boots on the ground. You're the person that's hustling on this. Your other 2 guys are passive, but they're providing the money, right? How does the equity work in that situation?
Yeah, so this was actually a deal that I decided to put some of my own money in.
Okay, gotcha.
On the 5plex, however, I did not put any of my own money in that.
Gotcha.
Okay. I participated in a couple capital calls, if we needed a little extra. I put some in, but from the get-go on that 5plex, I did not put any of my own capital in. On this one, I did, and the reason I did was a little bit on the comfort of the partners to show that I had some skin in the game. Gotcha. And secondly, I was hoping for more equity. I honestly wanted more equity, and so what I did was I retained a certain percentage, and I'll be honest about that. Let's see. I think it's about 25% of the partnership just to manage the deal.
And just as the managing member, 25 there. Okay.
25 there. And then the rest of the equity, 75%, would be split on a pro rata share with the money invested.
Gotcha. Yep. So as
So
much money, so 100K comes in, and you put in 20, you get 20% of that last 75.
yes, exactly.
Yes. So and you wanted a little more equity, so you kind of wear a managing member hat, active, and a money guy hat,
Yes.
silent partner. So you kind of have two revenue streams from this. Well, not revenue streams. I'll just say your equity comes from two places in this investment.
Yeah. So it easily so the numbers shake out like this with me being the managing member and me being a capital contributor as well. I have 40% of the partnership.
Gotcha.
My partners have 30 and 30 equal.
Mm-hmm.
So 40, 30, 30. And that's how we split it. And it's still split like that to this day.
And so the only legal you needed there, you formed a business. It all was outlined in your operating agreement. You've got clear paths to walk down if something goes wrong. I think the best businesses have a clear exit strategy, right?
Yep.
But of course, that's only in the bad days. And then you're sitting here putting in less than, not the full amount that's needed for the 20% to get into the investment, but you still have 40%, man. This is exciting. And so you can walk down this path. Now tell us a little bit about what excited you about this deal.
Yeah. And I'll back up one step there, Kyle.
Yeah.
And I need to put a little asterisk on this. You should, if you're putting together a partnership like this, you need to consult an attorney. I would say do not go to LegalZoom.com and download an operating agreement and put that together. The other thing you need to watch out for while you're putting this together with an attorney is making sure that you're not skirting any of the passive active investor security law, as with a syndication or a fund, where you have a general partner who's doing all of the work and operating the deal, and you have silent, purely passive partners.
Yes.
There are a lot of rules around that, and the way we structured it in having active voting members making decisions and contributing to a little bit of the work and direction of the investment, we were able to structure it this way and avoid any. So I just needed to say, I want people to go talk to an attorney before they do this.
That's a great point. And this is probably that part where we disclaim, hey, none of this is legal advice. We are not lawyers. We are not advising you in any way. However, we're just having a conversation about this. Very good insight there. And I love coming back to this can go all the way up to the 800 level college course, you guys. There's big deals where they have different classes of shares and everything. Don't let it get complicated. Andrew's saying to us, the simplicity in this is the beauty. But you always have to have your who. It's going to keep you one person removed from a legal document like that. And if you create a great partnership with attorneys, not only are they people that can help you write an operating agreement, but heck, they can help you find deals. They can help you do a lot of stuff with your investing journey. So very good point there.
Yep.
Anything else on the partnership? Any uniqueness on the partnership to make this deal go? One thing I did notice you say, you had the partners first before the deal came, which I think was a crucial thing you said.
Yeah, because there's the work around putting the deal together or putting the basically the business together. I mean, there's a good amount of upfront work there. So if you were scrambling to do that and all of the steps to acquire a property in terms of putting an offer together and trying to convince partners to come in, that can create some unneeded stress, I think, on the operator for sure.
Absolutely.
So I can talk about the actual deal.
Yes, absolutely. So you've got the crew, you've got the agreement, you're ready to pounce, you've been approved with a lender, and now we're hunting for a deal, and you come across the sevenplex.
Yeah. So Kyle, you are helping me find a deal for us, and we established what our criteria were, and certainly the price point. Because I talked about that was the other thing I talked to my partners about is like, how much money would you like to bring in, and how much money are we working with? And so we kind of had a price point there of, I think we were at like 250 to 350, somewhere in there. We had some flexibility in there. So, if I remember right, I found this on the MLS, and it had been on the market for a while.
Mm-hmm.
And I think you might have missed it as well. Both of us were like, how did we miss this deal? I don't know what happened. So we jumped on it, and let me just, for your listeners, we closed on this property. I'll jump forward a little bit and then jump back. We closed on this property the first week of May in 2020. Does anyone remember what was happening in 2020? A pandemic was breaking out, right? So we found this property around mid-March, April. Actually, you know what?
Mm-hmm.
I was working on this stuff when I was in Florida right before the pandemic hit. I remember. And so, that caused some confusion and caused like, do we still want to move forward? And we all agreed, again, voting, should we move forward? We all agreed, let's move forward. And so you and I found this property. I believe it was the seller needed to unload it for some purposes of a 1031 exchange, if I remember right.
That's correct. Yep.
And so it happened pretty quickly.
Actually had a deal identified as well. And so again, kind of the case of a distressed seller.
Yes.
Needing, not in the sense of anything bad, but just needed another investment to take the money into.
Yes, exactly. That's right. So we got the property under contract pretty fast. So when we were evaluating this property, it was clear that it was under rented, and all it needed was a turnover of a good amount of the tenants in the sevenplex. I'd say probably 3 or 4 of the 7 needed to turn over. Mm-hmm. So I don't know if other investors shied away from that aspect of it, but I knew that the revenue potential on this, from doing my homework for the market and working with you, was there, because we purchased this property for you might have to remind me. I think it was 269.
Yep.
And we knew the revenue potential on this was around 4,000. Mm-hmm. So just the numbers there, we knew that this could be a home run. Of course, we had a strategy that put in place. The group of us said, we're going to turn over the units. We're going to do some of the necessary repairs. We'll fix some flooring and all that stuff. And we did all that. And now I think we bring in, I think at the time it was bringing in maybe around 2,800, and it was intermittent, right? Not all the tenants were paying their rent and all that stuff.
Mm-hmm. Yep.
Now a full building, and it brings in about 3,900 in rent now on a monthly basis.
Man,
so
that's awesome.
Oh, yeah.
And I love that. I love this part. And I know you've heard me say this to you. You had to put on your investor hat and say, we need to stabilize the units. The building's okay. Yep. The location's good.
Yep.
The tenant situation is kind of iffy, and that's management. Luckily, that's a variable you can control. Yes. Or have. And so you came in, had to do some stabilization over a number of months. And I mean, now you get to sit here and we get to talk about it from the standpoint of after the dust is settled with literally $1,000 a month over the 1% rule or more. That's fun to think about.
Yeah. Yeah. And here are a couple of the sale went fine. The inspection went fine. We closed on that property in May. We started turning over the units. I would say it probably took a good 8 to 10 months to turn all of the units over. Actually, we just had our last tenant who was fine, actually leave just recently. So, I mean, all of the units have been turned over by now. They're all on long-term leases. I'm not going to name any names, of course, but I had to move away from one property manager to another. So that's always a stressful thing when you have to fire one of your vendors and find a new one. That there's no fun in that, but that's certainly part of the game. Part of being a real estate investor is making those hard calls. And we are just rocking and rolling on that property. And I'm sure we'll talk about the refinance that just happened.
Yeah, man. So, here's what we're hearing here, Andrew. You've got the Aberdeen property that got you into this raising money world, and you had some lending partners, you refied out, still have the asset. What an amazing deal. You've got ownership in the fiveplex in Fargo without putting any of your capital in, just being the managing member on that one. And then you've got
25% on that.
25% ownership in a fiveplex that you put no money into. And then you've got this deal, which you put some skin in the game, and you're the managing member that's cruising along, continuing to build. Our audience right now, I imagine, as my wheels are turning, their wheels are spinning on, what does someone need to start down this path as an option? Because a lot of people are out there, hey, I'm going to start looking for myself. But how can they add this to their tool belt? You've gave us a couple tactics already that I want to continue to expound on and get your advice and encouragement for people to take the next step down this, because it's an awesome way to get equity into deals, you guys. You're saying make your list. You're saying start talking about what you're doing. You're saying ask questions about the goals of your partners that you're talking to, the conversations you're having. Continue down this path for us on what the next steps are for people, because you've given us some good meat already.
Yeah, absolutely. One other thing that I would add there is build your team. So if you're investing locally in your city, your town, build your team there. If you're investing out of state, start building your team there. And so I have a team here in Denver. I have a team in South Dakota. I have a team in Fargo. I have a team in Grand Junction, Colorado, where one of our other properties is. And in each place, I need to find certain vendor partners, agent, lender, attorney, CPA, property manager. And that's where that book, Long Distance Real Estate Investing by David Greene, was a big help, because half of that book is about building your team. And here I'll interject that building your team and making those cold calls and asking for help and trying to fake it till you make it and convince people that you're the real deal is no easy task. There's no way to say it. If you've done this, 10 times, or this is your first time, there's always a little bit of fear in there. And so just expect that and just overcome the hump. I did have agents that never called me back. And I thought to myself, why do they hate me? Right? Why am I doing this? Is this really the thing? And then you get people like Kyle. And I made the cold call to Hatch Realty at the time, and he referred me to Kyle, and Kyle and I now have a great friendship and history. And so, you never know who you're going to meet along the way, but getting over that fear and building a team is going to be essential, crucial. So that's one thing I'd add there. Any questions on that?
No, that's an amazing point, and I love that you clarified what your team is, all the different vendors you're going to use. And you've touched so many times on how the people on your team have executed the crucial parts to move it to the next level, like with attorneys and the operating agreement. Almost every part of this. is a team member that's helping you accomplish your goals. And hey, did we forget to mention that keeps it passive too? That's what keeps you doing what you do best, which is loving your family, creating income while you need until this can take over.
Yep, absolutely.
So other next steps here, Andrew. You're kind of on fire with this stuff, with making this accessible for people. I don't think any of these are simple things, not easy all the time, of course.
Yes.
What are some other things for people on the next steps with looking at this?
Here's one it's not too tangible, but I'd love to mention is your mindset. Is your mindset that you're gonna grit this out no matter what obstacle comes your way? You got to be ready for it. You got to be ready to overcome. And I don't want to sound too woo-woo, but if I hear a lot of times that people don't want to give, people want to own and do it all themselves. So part of that is, refusing to build a team, or just not realizing the importance of building a team. But also, people don't like the idea of giving up equity. People want to own things 100%, and I'm going to crush it. If I have 100% equity, yeah, that's, you might be right. You're right. But are you going to be able to scale? Are you going to be able to do bigger deals? Are you going to be able to do faster deals? Those are all things about mindset that you can gain when you're willing to give up some equity. So in buying this 7plex, I couldn't do this, one, because I didn't have the capital personally. And I wanted to scale quickly. And so the only way I could do that is find partners and give up 75% of the equity. But if you think about it, if you look at the big picture, there are a lot of real estate funds and syndications where the operators are giving up 25%, or they're retaining 15, 20, 25% of equity. And the rest of the equity goes to all the silent passive investors. Mm-hmm. So my benchmark of 20 to 30% for operating a deal is right in line with, I think, where it's just a natural place in the real estate investment world to be okay with that much equity, as long as you're willing to put in that time.
Man, Andrew, this is great stuff, man. I just literally wrote down your quote: giving equity has gains to be had as well. Given the gain there, dude, that's good. That's such good advice. Everything you've said shows me that this is an accessible thing for people to check out. This is an accessible path for people to walk down, and they're only a couple partnerships away and a couple conversations away from possibly getting an equity in units up to 25%. This is so accessible, you guys. And so those barriers of time and money, man, I love it when people crush them like you. Andrew, our relationship is something I value. I hear a lot of the passion and the strategy. And even now, when you say fake it till you make it, man, you're such an expert in this, whether you see that or not. And I know you're going to hit your vision. You're going to hit your goals. How do people find you, man? How do people to latch on to what you're doing and learn more?
Yeah. I just recently, I started an LGS Properties Instagram account, and it's purely my real estate investing and observations and books I'm reading, and we're still building a lot of the content there, but it's LGS_properties on Instagram, and feel free to reach out, DM me on there. Happy to talk to anybody, share any knowledge, learn from anybody else that's doing stuff out there. I've got a lot to learn. I always do. So that's probably the best way, Kyle.
And possibly you might even have people reach out and say, hey, I want to partner with what you're doing, Andrew. So
absolutely. You never know. You never know.
We will, Andrew, we'll put all that stuff in the show notes for our audience. We've really enjoyed having you on here for this topic matter. Man, we just appreciate how you've shared everything, kind of opened the book and showed us behind the scenes of what you're doing, because you know that you have an abundant mindset about this whole thing, and there's room for all of us to create passive income in our worlds in order for us to create the lifestyle we want. So, Andrew, thanks for being here, man.
Thank you, Kyle. Appreciate it.
This has been the Passive 25K podcast. If you enjoyed today's episode, be sure to subscribe so you don't miss future conversations. Also, tell us what you thought by leaving a comment below on today's topic. If something really hit with you, don't be afraid to share this with someone else that's interested in passive income. Thanks again for tuning in. I'll catch you next time for another episode of the Passive 25K podcast.